Okay, so you want to buy a skyscraper. Find a plot of land in a major city, put up 100 floors of glass and steel, fill it with tenants paying rent every month, and watch the money come in. That's the version everybody imagines. But here's the part nobody tells you. You could spend $2 billion on that tower and still not own one single square foot of the ground it's standing on. For nearly 40 years, the people who ran the Empire State Building didn't own the land underneath it. A completely separate company did. In the 1990s, Donald Trump acquired half of that land claim and spent years suing the building's operators, trying to break their lease and seize control of the entire skyscraper. The judge ruled against him. But in 2002, he simply picked up the phone, sold his stake in that same land back to the building's owners for $57.5 million, and walked away with roughly $8 million in profit on a deal where he never put a single dollar of his own money in to begin with. That's how strange skyscraper ownership actually is. By the end of this video, you'll know exactly where the real money in a tower like this comes from, why the office floors people work on every day might be the least profitable part of the entire building, what's hiding inside the crown of half the tallest towers on Earth, and how much you'd actually walk away with if you tried this yourself. Let's start with what it actually costs to get in. Building a skyscraper from scratch runs anywhere from $400 to over $1,500 per square foot, depending on the city, the height, and how complicated the design is. A mid-sized tower of 40 to 70 floors runs somewhere between $500 million and $1 billion. A true super tall, over 70 floors, can cost anywhere from $1 billion to $3 billion before you've leased a single office. And a huge chunk of that money buys you space you can never rent out. Elevators, mechanical rooms, stairwells, and the structural core that holds the whole building up can eat up 30 to 40% of every single floor plate. You are paying full construction price for square footage that will never generate 1 cent of rent. On top of that, tall buildings sway in the wind, so engineers install what's called a tuned mass damper near the top, essentially a multi-million-dollar pendulum whose entire job is to sit there and counteract the building's motion, so nobody upstairs gets seasick at their desk. And none of those construction numbers even include the land itself. In a market like Manhattan, unimproved land alone can run into the thousands of dollars per square foot before a single beam goes up. That's exactly why so many skyscraper deals are structured as ground leases in the first place. Instead of buying the dirt outright, you lease it for 99 years, hand over an annual rent check to whoever does own it, and build your tower on top. It's the same structure the Empire State Building has used since the 1960s, and the same one behind landmarks like Rockefeller Center. You get to operate a skyscraper. You never have to touch the eye-watering price of the block underneath it. The trade-off, as Trump's failed lawsuit proved, is that someone else always technically outranks you on that land for as long as the lease runs. Now, you might be wondering if there's a cheaper way in, like buying an existing tower instead of building one from the ground up? There absolutely is, and right now it might be the smartest move in the entire industry. Office towers across the country have been trading at historic discounts ever since remote work emptied out downtowns. A 23-floor office building in Midtown Manhattan sold for $332 million in 2006. In 2024, that same building sold again in an online auction for $8.5 million, a 97.5% discount. In Chicago, investors paid around $85 million for a 57-story tower that had sold for $374.6 million just a decade earlier. Nationally, buyers scooped up more than 200 distressed office towers last year alone, a $5.2 billion shopping spree, and the pace has only picked up since you can quite literally buy a skyscraper today for a fraction of what it cost to build 20 years ago. The catch is that most of those towers are sitting two-thirds empty, and filling one back up is its own separate expensive business. Now we get to the question that actually matters. Where does the money come from? Most people assume it's simple. You rent out the offices, tenants pay you every month. Done. And office rent is real money. In Manhattan right now, a standard tower charges somewhere around $85 a square foot a year. A trophy building on Park Avenue or in Hudson Yards can charge $120 to over $150 a square foot. Multiply that across 1 million square feet of office space and you're looking at well over $100 million a year in gross rent alone. But here's the twist. In the most famous skyscraper in America, the office floors aren't even the most profitable part of the building. The Empire State Building has 2.7 million square feet of office space, spread across its 102 floors. and yet its 2 observation decks, a sliver of space on just 2 of those floors, generated close to $100 million in profit in a recent year, at a 75% profit margin, accounting for roughly 40% of the entire building's revenue. Analysts have valued those 2 floors alone at around $1.7 billion, or about $20,000 per square foot, which makes them, foot for foot, some of the most valuable real estate on the planet, worth many times more than the office space surrounding them. For decades, the building even leased space on its spire to television networks for their broadcast antennas, quietly collecting hundreds of thousands of dollars a year for renting out air that nobody could even stand in. The lesson generalizes past one famous building. Ground floor retail routinely rents for 2 to 3 times what the office floors directly above it command, because a shop at street level makes money every hour its doors are open, while an office floor only earns rent when a company signs a multi-year lease. In a skyscraper, the money doesn't cluster where the tenants actually live. It clusters at the very bottom of the building, and if you're lucky enough to own something people want to see, at the very top of it. And here's the part that breaks people's brains. A meaningful chunk of the world's tallest buildings aren't actually as tall as they're advertised to be, not in any usable sense. Engineers call it vanity height, the gap between the highest floor a person can actually stand on and the very top of the spire. The Burj Khalifa, the tallest building on Earth, has 244 meters of vanity height. That's 29% of its entire structure. If you sliced off that unusable top section and stood it up on its own, it would rank as the 11th tallest building in all of Europe. Strip vanity height out of the record books entirely, and 61% of the world's so-called super tall buildings would lose that title. The planned Jeddah Tower in Saudi Arabia takes it even further, roughly 370 meters of its total height. Close to 40% of the entire structure will sit above the highest floor anyone will ever actually be able to stand on. Developers add these hollow spires almost purely to win a height record, because a height record generates headlines, and headlines fill office floors. You're not just paying full construction cost on space inside the building you can never rent out. Sometimes you're paying to build hundreds of feet of tower that isn't functionally a building at all. Step back for a second, because owning a skyscraper carries risks most businesses never have to think about. The most obvious one right now is vacancy. Remote work never fully reversed, and office vacancy in Manhattan still sits around 13 to 19%, with plenty of other American cities running much higher than that. Analysts at Green Street, a firm that tracks commercial property values nationwide, estimate the average office building has lost around 35% of its value from its pre-pandemic peak. That's precisely why towers are trading at 97% discounts in the first place. Lenders and previous owners finally accepting that the old office world isn't fully coming back, and that holding out for it costs more than simply selling. Take Brookfield, one of the largest real estate owners on the planet. In Los Angeles, Brookfield defaulted on $400 million of debt tied to a 57-story downtown tower that had been worth $605 million a decade earlier. Today, it's appraised at roughly a third of that. Lenders have a name for the broader pattern playing out across the country: extend and pretend, refinancing a struggling tower again and again. Instead of admitting how far its value has actually fallen, it delays the reckoning. It doesn't cancel it. Then there's the risk almost nobody plans for at all. In July of 2001, a developer named Larry Silverstein signed a 99-year lease on the World Trade Center for just over $3 billion, putting up only $14 million of his own cash. 6 weeks later, the towers were destroyed on September the 11th. What followed was years of litigation over a single sentence buried inside an insurance contract, whether 2 planes hitting 2 towers counted as one insured event or 2. Courts split the difference, and insurers ultimately paid out $4,550 million money that went toward rebuilding what's now the new World Trade Center complex. Owning a skyscraper means owning one single, enormous, physically concentrated asset. When something goes wrong with it, there's no second building to spread the damage across. It's all or nothing in one address. Time to pull it all together and answer the actual question: how much money do you make if you do this right? Let's run the math on 3 realistic versions of your skyscraper. Option 1, you buy a distressed tower out of financial trouble, the way today's opportunistic investors are doing across Chicago, Los Angeles, and Washington, D.C. You pay around $80 million for a large but roughly 1/3 occupied tower. You spend another $60 million on renovations and leasing costs costs to pull occupancy up toward 80%. Once it's stabilized at a modest $60 a square foot on a million-square-foot building, you're generating close to $48 million a year in gross rent. After operating expenses eat up around 45% of that, you're left with roughly $26 million a year in net operating income on a $140 million total investment. That's an excellent return if you can survive the 2 or 3 years it takes to actually fill the building back up. Option 2. You build a brand new trophy tower from scratch in a major city. Land, construction, elevators, dampers, permits, all in. You're spending close to $1.2 billion once it's fully leased at $90 a square foot across 1.5 million square feet of office space. You're pulling in about $135 million a year in gross rent. After typical operating costs of around 45%, you net roughly $74 million a year, a return of about 6% on your total investment, before you even count the observation deck, the ground floor retail, or the naming rights, which is where the real upside actually lives. Option 3, and the one almost nobody considers, you don't buy a building at all. You buy a slice of one through a publicly traded company that already owns a landmark tower. The same way anyone can currently buy shares in the company that owns the Empire State Building itself. That single asset alone generated close to $100 million in observation deck profit last year, on top of its office rent. And you don't need 8 figures to own a piece of it. Sometimes the smartest way to own a skyscraper isn't to buy the whole thing. It's to own a fraction of the best square footage inside it. So the next time you look up at a skyscraper, remember what's actually happening inside it. The people on the middle floors typing away at their desks are paying the bills. The shop at street level and the deck at the very top are making the profit. And the crown above all of it might not even be a real floor at all, just steel and glass built to win an argument about height. In the end, you never really own the ground under a skyscraper. You just own what happens on top of it.